the size and the growth of the investment channels. So this is what initially he started his explanation with. But when I went deeper into a discussion and I take him forward with few of this preconditionalities the loss aversion or the herding mentality or any kind of superstition, has he ever been affected while taking decision? Surprisingly what his answer was,
what was
he
it?
said that, ma'am, early morning I used to take tea on my balcony, and while taking tea I used to watch the number of birds sitting on those cable of my balcony. And if the number is odd one, I feel that it is a lucky day for me, and I should not be hesitant enough to go to the market. But if the number is even one, I would really feel unlucky, and that day I will be pretty much hesitant to work into it. So that gradually means I'm serious. I'm not stating in that this is what exactly happened. Even if there is no correlation between the number of birds which are sitting on his balcony bias with the investment levels or with the decision make, there is no connection. But still then, even if the CEOs or the managers or the investors, those are sitting.
So this is what the IITs and IIMs ultimately boil down to.
Exactly.
The bird in the balcony.
So the world that is what I want to start with our discussion is the corporate finance and how do the behavior affects corporate finance. And yes, this is what researchers have also integrated deeper into. So we cannot say that as human being, we are completely out of our biases. Howsoever we may say that, okay, we'll say that we are risk averse, but rather than saying it to be a risk averse or a risk seeker, we as individual would be more of a loss averse rather than that of a risk averse. So that is what has reconstructed my level of thinking before I start with our session today. So
exactly, this was a nice icebreaker. Exactly. So this is what a corporate honcho is saying.
Exactly. So coming
and it is from the horse's mouth. It's from the horse's mouth.
Horse's mouth that yes, they are also not being completely escape from the world of behavioral biases.
Ma'am, towards the end of my session, if I may interfere, one Dr. Ravi, he is a senior participant and a consultant in this group. He was just asking, sir, is it only with finance or with any decision that we face biases? So in the preceding session, in the question answer session, that is what was asked. So this is what we come to, that we don't know where the biases come from and how they get created. And the list is endless. Another Sonalji asked, that is the list exhaustive? This is, I said, that we don't know what biases will crop in different situations in our mind.
Yes, that is how we, because this is an exploratory process. As we dig deeper into it, we tend to level out that what are those biases and how do they exist.
Exactly. So, ma'am, before you formally begin, let me just introduce you in brief, reintroduce you.
Sir, not exactly needed.
I guess every one of you remember that she is Dr. Shikta Singh, Associate Professor from KSOM, KIT School of Management, KIT University, Bhubaneswar. Now, all of us, I am sure none of us suffer from short-term memory loss. So, we remember ma'am very well. So, ma'am, over to you.
Thank you so much, sir. Thank you so much again. And thank to Burdwan University for again inviting me and coming up with such a absolute niche area of discussion, which is perhaps in the way forward, which research world looks into. And that is how the role of behavior, it is not that it is pertaining to the finance world, but what we see that the behavioral changes, which also has to be a very pertinent part of the work that is somewhat missing out. So in the last session, we discussed about the various types of anomalies which is affecting the market. Some anomalies are permanent, whereas some anomalies, they are likely to be there, but at certain point of time, they can also disappear. So that is how the various calendar anomalies, which we discussed last, in terms of the January effect or month of the year effect or holiday effect, how do they have an impact on by judging the investors' biases. But before I start, let me take up a quick look into this video. I hope my screen is visible to all of you.
Yes.
Cola bottle is 100 years old this year.
The video is audible?
That's even older than I am. I think that calls for a song.
Yes, please.
Yes, ma'am.
Back to that key.
Okay.
The Coca-Cola bottle is 100 years old this year. Wow, that's even older than I am. I think that calls for a song. Well, let's go back to that key. Cola, keep it company. I think I'll move this just up a little bit. I like to teach the world to sing in perfect harmony. I like to buy the world a Coke and keep it company. Of course, I could buy the world a Coke, but I'm not sure my shareholders would go for that. Boy, that is the real thing.
So I hope this
Coca-Cola bottle is 100 years old.
Could, to some extent, trigger a sense of direction to the point of our discussion. I hope everybody is aware of Warren Buffett and his level of purchasing which has done with the Berkshire. But this video was somewhat interesting to find out another side of his facet, where clearly it has indicated the role of behavior in which he is tending to have its decision. So the field of corporate finance, which might well be in the area of economics, as well as in the finance, and with the most misleading name, where we take up behavioral economics and or behavioral finance as a close end, many of the work identified as corporate finance that dealt with neither with the corporation nor with the financing decisions actually. So today's session, I would like to conceptualize into the breadth and boundaries of corporate finance research, and then put the advances that have resulted from applying the insights of psychology as well as the insights of certain irrational decisions through certain tools which will have certain long-standing puzzles regarding the corporate investment, respect to mergers and acquisitions, corporate financial choices. So naturally, this enterprise would entail the discussion into the key research questions and development into the field of the behavioral corporate finance. So when we look into corporate finance, have we been ever distinguished by the level of thinking that do corporate finance are affected by the behavioral biases? Yes or no? Yes, many of you can also go with your responses. Do behavioral biases, which we have discussed few of those behavioral biases, do they affect corporate decision making at the, even if it is the level of CEO or the board of directors or the other investors? Do they affect, or is it a level of a research arena which one should go for? Yes or no? So could you please help me to So my question is, do behavioral biases affect corporate decision making?
Yeah, responses are coming. Yeah, all are saying yes.
Have you experienced, or is there any experience with any one of you where you find that corporates affecting these biases or has been affected by these biases? No experience? Okay, before that, there is a link which has been provided in the chat box. A short profiling before we proceed. All of you have clicked into the ring, no experience directly. Cost of service mentioning. Okay, so all of you might have clicked on to the link. You see the questions right out there? Either you can use this code which you're saying 40834336. So the first poll was, would you accept if someone gave you rupees 100 and kept rupees 900 with himself? The poll is yes or no. Would you accept if she gave you 100 and kept 900 with herself? Or if you're not able to put it up in the poll, you can give it in the chat box. Yes or no? Yes, I'm seeing the responses 14, 11. Okay. Second is, would you accept if she give you 400 and kept 600 with her? There are only 6 to 7 participants, those who are responding.
Kindly share the link once again.
It's ma'am in the chat box.
No, actually, I logged out, so
okay.
It's not there.
Okay, ma'am. Okay, I see 14 responses coming up. Okay. Let me stop here. So when it was asked that the amount which was given in terms of the investing is 100 and the rest is taken up with herself, and the second one where the amount changed from 400 to keeping you and the rest with 600 with her. So what do you notice? This was the only change in terms of the distribution or the capacity to averse the level of loss. Behavioral finance, therefore, takes one of a very pertinent bias, which is the disposition effect, into its level of analysis. For instance, when you see that the prices of a well-performing stock is increasing from say 70 to 80, and you are expecting that next moment it is increasing trend, it's showing an increasing trend. So the usual attention of an investor is to sell off or riding stocks. But if you find that the stock starts underperforming, it takes a peak fall from 70 to say 40, then generally the investor would like to hold on to this stock with an intention that in the future those stocks will have a rising rate. So this is what is basically the disposition effect, which is called up by the behavioral finance people. So when we look into the world of corporate finance, so in corporate finance, we are concerning with the financing and the investment behavior of the companies that emerges from the interaction of the investors, the managers, and the other stakeholders. So basically, we are looking into that how do an investor or a manager, they respond to the various financial decision making with a degree with their stakeholders. So those investment channels can be with reference to either what will be the impact of a bias on the valuation of a company, or what would be the impact of a bias on the capital budgeting, the capital structure, mergers and acquisitions. Do they work on the basis of the behavioral biases? Agency conflict, do they arise due to the interference of any of these biases? So many of these researchers have shown the role of the managerial irrationality or their biases, which has an impact on the corporate finance decision making. So this corporate finance or the behavioral finance in this particularly is based upon a positive approach. So positive approach in the sense that where we are dealing with facts finding, where we are stating that what actually is going on in the market. So what actually is going on, the rational managers tend to study that. So it can be purely fundamental, looking into the size and the growth anomalies, which we discussed last. So usually it has been seen that the small stock or companies, they have been outperforming rather than that of the large cap. But that doesn't mean that all the investors, they have a, going by this trend, they start investing more and more into the small cap rather than that of. So based upon the positive attribute, or we can say that a non-normative attribute of the market, which considers that what actually is, because the rational people, they do always what they want to do. Their fundamentals are clear they are backed by the sound macroeconomic indicators. They look into the trend analysis, they look into the factors. If I ask you the factors, you will certainly look into the market. You will certainly look into that, what decisions the government has taken with respect to the companies, the various macroeconomic factors pertaining to the rate cuts, pertaining to the changes in exchange rate, pertaining to the any change in the government policy. Based upon that, the company can also undertake a change into this. So all of them are positive approaches. But the second part of the indication is when we talk about the non-normative, the normative approach, that is, which is somewhat, which is working on a controlled approach, and it is backed by certain constraints, because subject to certain limitation, subject to certain boundaries, the financing companies start performing in that manner. So while behavioral finance that looks into the positive approach, the non-behavioral approach looks into the normative approach. And that is the reason, if you look into the three efficacies of the functioning of the market, right from the efficient market to the rational managers, which the neoclassical theories has very well researched in. But again, the second market where it has seen the inefficient markets, the market become inefficient due to the existence of various anomalies in the form of calendar and fundamental anomalies, or you can say that the financial anomalies, which make an efficient market to be inefficient, and the role of rational manager. And the third set of category of research is much more into the behavioral side, where they trigger into the inefficient market and the biased managers. Why bias? Because this has seen that the corporate finance has not been an exception of not being affected by some of the biases, and earlier researchers has very predominantly found that overconfidence or optimism bias has been a very, very pertinent factor while making any kind of decisions as far as the corporate financing world is concerned. So therefore, the real world decision with inadequate and imperfect informations do exist. And that is why it leads to a creation of solution which were rather at a suboptimal position than that of a completely optimal one. And they have limited cognitive capacity, which are completely relying upon heuristics. So heuristics, if a CEO is affected by a certain thumb rule, which is existing in the market, then that creates a bias in terms of making and landing up with certain judgmental errors. So that is why different sources of irrationality, which we proclaim in the form of behavioral biases, that emerges either from the cognitive as well as the emotional differences. So in the few earlier sessions, many of those cognitive errors which have emerged from the information processing or the mental shortcuts, like the anchoring, where we are indexing upon a reference point while taking any decision and making our decision based upon that anchoring bias. Or there are framing effects in terms of how the things are presented before us. Either it is presented in a positive way or it is presented in a negative way. Usually it has been seen that the people tend to avoid risk when they are put up in a in a negative frame of mind, rather than they tend to seek risk if things are presented in a positive frame of mind. So framing has been a very, very important part of behavioral biases, which is an example of cognitiveness in which people react to make a particular choice in the ways the things are presented before them. Hindsight is something, a kind of bias where you say that you know everything. If the board of directors, if the companies, because hindsight bias leads to creation of overconfidence. So if the CEO of the company have a kind of mental ability in terms of knowing everything, and based upon that, he comes up with a rationality mistake, then that can also affect the decision as far as investment is concerned. And we also discuss about mental accounting, which is otherwise called as the two-pocket theory, where always as human being, we tend to divide our expenses into different set of separate accounts. We keep a money jar in terms of laying out our expenditures, in terms of laying out our portfolio investment. So mental accounting, the efficacies of mental accounting has also been a very important consideration to undertake as a part of study when it comes into the cognitive biases. When it comes into the feeling, if you look into, I would like to mention Alan Greenspan, where he had very clearly stated that a person is someone, a human being is always evoked by the animal spirits. So animal spirits is something that we as human beings are continuously subject to a level of greed, fear, and there is a roller coaster of emotions which goes into a person. Because there is a lack of self-control. That is what Daniel Kahneman in his research has also brought about. So if all these biases are not rightly addressed, that can create impact in terms of deciding that how the decisions are taken forward. So based upon this, if I look into the rationality or the researchers based upon the behavioral corporate finances and the role of biases in investment decisions, they basically move towards a top-down approach for the investment decisions. So top-down approach where fundamentally when the CEO or the manager of the company look into the various factors, it look into the market, it addresses the various macroeconomic factors, then it looks into the industry's analysis, the company's analysis, and the level of asset investment, until and unless this part of the biases have started impacting his decision. So the Ritter in 2003, who was on a Nobel Prize for his work, and is a professor in Florida, he stated that the socio-economic psychological factors that make your cognitive evaluation and heuristics, which is a rule of thumb, where you believe that good stocks are stocks of a good companies and bad stocks are surely due to the stock of the bad companies, and you follow this rule of thumb while making your decision plan as far as the investing channels are concerned, then essentially you allow heuristics to affect your decisions. In your class, while dealing with finance, very often, I hope all the finance professors would have taken the case of, if you ask a student that a good stock is of a good company, so is it good to invest or not? So the answer may be that it is not necessary that always this proposition hold good. It may vary, but still then, if the manager of the company holds on to this cognitive bias while taking any decision, then surely the investment process gets affected. Similarly, the other biases which we have discussed, like overconfidence, mental accounting, framing, representative, conservative, disposition effect. So where I stated right now, disposition effect is nothing but it is a way in which you are holding on to your losers and selling out your winners. So if you find that your stocks are performing well, you tend to sell off them. But those who are poorly performing, you tend to hold them with an expectation that they will have a surely increasing prices. So that is what a disposition effect also has an impact upon the investors or the managers, those who are dealing with, apart from the various fundamental theories which we'll look into here. So when you go into an inefficient market, you find more of the assimilation of both micro and macro factors impacting the rational decision making. And that is why the cognitive evaluation, which is affected by both these factors as well as the emotions, and they have an anticipated outcome with a subjective probability, including other contextual factors, these create an impact on a decision with a outcome, including the amount of emotions which are also taken a note while making any form of research, including the irrationality or inefficiencies in the market. So that is why when I stated that inefficient market and financial decisions, how do they work? They surely work because of the assimilation of both the macro as well as the microeconomic factors. So if you look into the noise traders and the arbitrage, I would rather consider these two as a macro prospects. Why? Because the traditional market, they say that in economics, we have studied that market clears or market is in equilibrium, right? But in reality, market never ever does to be in equilibrium, because if you look into the association between there are certain noise traders, there are certain arbiters in the market. The role of the noise trader will be they will tend to overestimate, they will create a noise, and they will tend to pull up the prices, right? But the arbiters are someone, the arbiters, they usually trade on fundamentals. So that is why when there's a consistency between the role of the noise trader and the role of the arbiter, that again tend to neutralize the market, and thereby the market tends to clear. And that is why essentially in finance theories, there has been a statement related to that. Always a limit has been set to the arbitrage. So the prices will never come back to equilibrium. So they can call limits to the arbitrage. And that is why the various other irrational factors, microeconomic factors, which Alan Greenspan and Schiller has clearly examined, the influence of irrational exuberance, which I was mentioning slightly before about the animal spirit, how the factor of greed, anxiety, the fear in a market also disturbs the entire market. The 2008 financial crisis was completely due to the occurrence was because of the irrational exuberance. The dot-com bubble crash was also a cause, was behavioral rather than completely financial. So the Indian market, which are mostly dominated by the institutional investors or the FIIs, they they believe in a system where not only the anomalies which work it in the form of market, where we have classified market anomalies into the calendar and the financial anomalies, and the market timing. I hope all of you have also come across a term called as Muhurt trading. So Muhurt trading is somewhat where the market timing is considered to be a very important part while making any decisions. That it is, I'm not saying that if it is the responsibility of the market or it is the responsibility of my mindset and how should I take over that. But Becker has very evidently presented in his study where he has shown the influence of market timing catering to the investment decision making. And therefore, the role of investment sentiments as well as the prospect theory calls for one of the few most factors which have affected the financial decisions. Any questions? If I would like to take a pause, I hope I'm reaching to the participants.
Ma'am, there's a question.
Yes, ma'am.
Please explain limits to arbitrage and irrational exuberance.
Okay. Ma'am, first of all, what does an arbiter mean? What is the role of an arbiter in a market? Or who is an arbiter?
Who takes advantage of the difference in prices in different markets.
So, in that sense, what will be the role of an arbiter?
He's taking advantage in the price change in different markets and taking advantage of it.
He takes because of the inefficiencies which is occurring in the market, he tends to some extent exploit the market and take advantage of that.
Yes.
By making certain simultaneous inefficiencies.
Yes.
He tried to upset, because one has stated that there are certain noise traders, because noise traders, they tend to create a noise. There are certain insider noise traders also, where the market tends to take, because this insider noise trader are not a part of the inefficient market. They tend to create a noise knowingly in order to pull up the prices. But the arbiters, they will tend to take advantage of this situation. So as a result, what will happen? The prices will neutralize. And that is why a limit can be set to that. But irrational exuberance is something which is related to the power of the human emotions. So when you call about the human emotions, our mind is particularly those who are having a higher emotional quotient, they have a higher strategy or a higher bent of equation on that what is the level of anxiety within me. For example, if you go to the market or in your institute, you start your morning with, you expect that you have done a very pretty much good work during this past few years. But when you go to the institute and you are stated that you have been underperforming, you are not doing well, what kind of mindset is going to impact upon you? Initially, would you start working at the same spirit as you were doing? Or it will take some time to you to recover or to reconcile?
Yes, it will take some time.
Why it is taking time?
Negative impact due to feedback.
Exactly. So your expectation is, your thinking is that you have created a positive kind of sector over a period of work in terms of your performance. But when you get a negative feedback in terms of your performance, despite of your all effort, that to some extent demotes your level of spirit of working in the performance as you are doing earlier, right? So this is again a part of irrational exuberance, because human brain is consistently putting into the effects of emotions, anxiety, fear, greed, And market, you cannot deny that market is not a subject to all these factors. Why we take in terms of, if I'm an investor and I see a market rising, what is my inherent factor saying? Isn't there a greed factor to invest more?
Yes.
It may be that, okay, you are looking into the trends of the market, you are going by the EMH, you are following that EMH, you have been seeing that how this past stocks are performing. But still then, is it not the greed factor within you which is somewhat driving you to invest more into that? So that is what is the case of irrational exuberance, which is imbibed by the animal spirits. We call it as, in behavioral finance, the animal spirits. If you want to go, there is a book on animal spirits, very wonderful book, where it very clearly enlists the impact of emotions, greed and fear, as well as the other forms of emotion which has impacted the market.
Thank you, ma'am.
Thank you, ma'am. So these areas are something which has been rarely discussed as a part of the research. And each of this, and if we are aware of each of these factors, because these are the dimensions, these are the constructs. Market anomalies, if I want to study the impact of market anomalies on the financial decision making of a corporate sector. So that will be my hypothesis. So in order to further dig deeper into this hypothesis, I have to again work upon the various qualitative indicators, because these are something which are qualitative, and we have to capture the essence of certain KPIs or measurability indicator, so that we can convert this qualitative into quants and come up with our research results in order to either accept or to neglect the hypothesis, right? So what I'm trying to state that apart from the various rational factors, fundamental factors, market factors, which has been for a long time dominating the market, we can bridge the gap by taking into these qualitative components and come up with a newer set of results where you can say that, okay, this has also to a greater extent impacted the market apart from the earlier one. The thing is that this people have not realized this is something which a kind of a nudge effect is. Let me cite a very interesting, maybe you might have also experienced that. Right now, we are not going to INOX or the movie theaters. But earlier, when we were going to that, I'm talking about 1.5 years back, the INOX, they were selling the popcorns of different sizes, right? So there was a small size popcorn and there was a large size popcorn. So the small size popcorn, what was the average price of a small size popcorn? Maybe 120, varying upon cities to cities with a marginal difference.
Indication for employability. Because most of our students come to the college or higher education for job. It is not for wisdom. Therefore, how do we create and prepare them for the employability?
Hello?
As Professor Suranjan Das said, and only 25% of the engineers are able to get a job immediately with their skills they have learned.
I hope some participants.
In Kerala, we have noticed that only 29% of the students pass the exam.
I hope Dr. Rajendra Nath is busy with his classes. Hello? Can I continue? Professor Avik, are you here?
Yes, Professor.
Yes, ma'am.
Okay. I know that slowly and slowly this efficacies of learning, I might be showing a declining stage. But actually, in reality, what I was trying to say that there are certain kind of reinforcement effect which do exist in the market. There are certain positive reinforcement. There are certain negative reinforcement. I was mentioning about the issues related to Inox, about the availability of the size of popcorns, which people were interested in buying. So there was a small size and a large size popcorn, and the basic difference between the pricing, if you go, was small size was hardly between 125 to 135, and a large size popcorn was say 165 to 175. But the dealer or the distributor who is dealing with the selling of popcorn, he initially introduced a mid-cap or mid-size popcorn, thereby making a marginal difference between the price of the small and the large. So when the crowd get to know that there is no difference between the mid size and a large guy, say the price is only say 25, the distributor or the seller tends to create a reinforcement effect in the minds of the crowd without their realization, and people gradually tend to buy the large size popcorn, finding out, okay, the price difference is only 25. But gradually what it had done, it has increased, or it has plunged the sale of large size popcorn because of the introduction of a mid size into the bracket. So this kind of strategy is somewhat called as the decoy effect, which behavioral scientists, they look into that, and various market gimmicks also look into while making decisions, where certain reinforcement are done, thereby without the realization of the crowd, but then things ultimately impact or affect. So that is what we are trying to find out, how this irrational exuberance has been created in terms of leading the behavior as a part of affecting the biases. So bringing back to those biases, actually through this we are trying to do a sentiment analysis of the investors. And various studies have also gone for this. If I look into the old history of 200 years old of history, economic history, they have completely negated the prospect theory or the loss aversion theory. And we were very much, evidently, we can say that the investors were more of a risk averse rather than that of the loss averse, as stated by Carnell and Tversky. So that is why the nudge effect, which was a very, very essential part of the bounded rational theory, and for which Richard Thaler has won Nobel Prize for his work. So nudge has been a very, very important part of a factor while determining the decision. Surprisingly, you would be also aware or not, in US, till now, what is the vaccination drive? Any idea? In US, is it the vaccination rate 100%? The vaccination drive is still yet to be, it's just 70% not yet to be done. Why? Because the president of US has very clearly stated that people, it's up to their choice. They have not come up any coercive action. But if you look into India, we are almost closing to the level of vaccinations drive. Is it not that due to a forcing effect, institutions are forcing those who are not vaccinated? There are certain positive as well as negative reinforcements as far as the vaccination drive is concerned. In the state of, I would say that in the state of Odisha, our Chief Minister has successfully gone through this nudge effect for 100% of vaccination in the state of Odisha. So various elements of nudge has also been primarily affecting the market, and how do market responds to this, it has also been a very, very essential part of the study. And that is what we are going to discuss in our further point of discussion. So as a part of this, I hope my slide is visible. Hello?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
So as a part of this, where Carnell and Tversky have studied the risk attitude behavior, they have looked into the prospect theory, where we are actually studying that the risk attitude is not the same across in terms of gains and losses. It is just a change in the matter of wealth rather than to the level of wealth and how the people respond to the wealth acquisitions. And the expected utility theory clearly assumes the people value on the basis of the outcome, which are the relationship between the utility and the wealth generation. So if asked, people are likely to be averse to make, unless and until they have that amount of appetite to bear loss, they are averse to make losses, and rather the pain of the loss is rather more than that of the happiness of gaining. And this is what is a loss aversion principle, which has been stated in terms of the prospect theory. So this concave position of the domain is consistent with the risk aversion. We have a calculation based upon this in terms of our econometric gains. And this indicates the convex in terms of the negative domain, where it indicates the inclination of the risk-seeking approach by the investors. So going by the prospect theory, actually the investors can face two kinds or two stages of decision making, one being at the editing stage and another being at the evaluation stage. So in editing stage, what they do, the decision makers, they frame the choice in terms of potential gain or loss in reference to a fixed reference point. But in evaluation stage, they will employ that either they will fall into the category of risk averse or a risk seeker. That will be decided in the evaluation stage. And that is why the curve indicated is somewhat in a S shape. One part of the curve indexing the concavity and another part of the curve indexing the convexity, which has a different implications. To further understand it, I have taken an example. Let me take that. To sell the winners and to lie the losers, we take this prospect theory into consideration. And in corporate finance also, this has been taken as a part of the study. So consider an investor who bought a stock a month ago for rupees 100, but the stock is currently selling for rupees 80. So in that sense, let us assume that the investor expects the stock to go back to 100 if it has fallen to 80, or it can also assume further that it can fall to 60, both outcomes remaining equiparable. So here you can clearly see that there can be a probability if from 100, it has a probability of falling to 80, and then it's coming down to 60. So in that sense, what can be the causality of such a change? So according to the prospect theory, here the investor is framing his choices as a choice between the two lotteries. That means he has to be either agreeable that let him sell the stock now and realize that he has only made a paper loss of say rupees 20, or what he can do, he can hold on to the stock for one more period, which equals or to the break even, and losing an additional of 20. This is what it can be done. So the choice between the two lotteries which falls in this loss region, as you saw in the figure, it is associated with a common portion of this typical S-shaped value. And that is where it calls for a region of the pattern of risk attitude behavior of an investors in terms of seeking risk or in terms of averting risk. And the third fundamental factor of neutralizing risk has also been discussed by Kamen and Tversky in their works. So that is how the prospects has a very, very important factor as far as the fundamentals of corporate finance is concerned. Today, I was going through the India Time group, and surprisingly, it found that there has been a mounting rise in the Sensex, and it has outperformed its peer. This is the just 24th. Yesterday, it was released. So the Sensex, as far as the Indian market is concerned, it has been the outperforming in comparison to the other indicators, Dow Jones, CAC, DAX, Nikkei, and all that. Any quick thought about what has been or what could have been the reason for making such an outperformance than that its peer groups?
I think people wanted to park their money in these stocks because they don't have any other opportunities.
Okay, so people want to park their money. Why, sir? Do you think that people motivation to park money in the stock has suddenly increased?
Yeah, because they want to save money. They do not want to spend. Earlier, people were traveling, going to the tourism place or whatever it is. Today, they want to save money. And when they find the market is rising, they have the hope that at least it will stay. So let me park the money, and they find it is going on very well. Yesterday, we just crossed 60,000 BSE.
Exactly. So is it only fundamental? The reason here, could you sense that the mindset of the people, either it is the individual investors, and for that matter, the mounting Sensex has been also surely due to the institutional investors. There has been a lot of imposition of this benchmarking due to the institutional investors even. So is it surely because of the fundamental or the behavior, or it is something related to the behavior which has seen it rising in the performance?
No. I mean, one thing I just talked about personal financing, right? If you take the institutional finance, it's also same thing. They don't have any kind of opportunities today.
Is it not mental accounting then? Are you not then, as a part of your system, if you want to save more and you are taking it as a diversification of portfolio where the market is rising, and you then start investing into that, is it not a mental accounting?
Yes, definitely.
This is what again goes by the prospect theory, which I was again rightly mentioning. So if you look into this fundamentals, another interesting thing also, sir, you might have been aware of, if you look into the individual investors, those who have dominated the India's market share now, this is the proportion, and you find that the amount of individual, the statistics in terms of the financial year 16 to this 21-22, what do you notice over the period? The share in the total trading volume has taken a spike as far as the individual investors are concerned, followed by the other categories, then the FIIs and the DIIs. So again, what does this consistently growth pattern indicate? the number of investors entering into the market, is it not, apart from this market performance, would you not associate with as an herding approach? The market is backed by the herd mentality. Because if I'm saving, what is the amount of interest do I get? Again, apart from the herding bias or a herding mentality, the CEO effect also, which act as a familiarity bias. If the CEO of the company is investing in a particular set or a portfolio, it will influence the employees also to make their investment into that portfolio. So is it not again something which is backed by a behavioral component rather than that of the non-behavioral one? So this is surprising. I hope you have all senses to disagree with me, but is it or is it not? Hello?
Yes, madam.
Yes.
It is to some extent.
It is. Sorry, please go ahead. I was talking. Please go ahead.
Yes, sir. Yes, sir. You can please. So this is a matter of exchange of ideas. And as I stated, it is not something which I am here and I have to come up with a monologue action. It is always a pleasure to go for a bilingual discussion.
No, I wanted to give chance to other participants. Okay.
Yes, anyone else would like to?
Yes, madam. It is herding itself, and there is a peer influence to some extent also that I see other people investing in the stock market and earning more returns as compared to the normal FDs and other things. So I also get interested. So that may also be another reason. Herding is one of the reasons, but peer influence is maybe one of the another prominent reason. Yeah, earlier time it used to happen that somebody has invested in SBI FD. Then he has informed me. Then again I tend to invest in that market. So now, as you can see, that the number of retail investors are increasing. So it is also having some kind of this peer effect also, that I'm observing someone else. So it can be a high to actually it is going towards herding actually. Yes.
Absolutely, sir. Absolutely. Very well stated. So that is what exactly. So without our realization, we are influenced by our peers. We are influenced by our family. So in behavioral finance, these are nothing but this states the occurrence of familiarity bias as well as the peer bias or herding bias, which has indicated the market in terms of a growing fund.
Madam,
Yes.
can I add something more to
Yes.
it?
Yes, sir.
And please give me your opinion also. That I also think that previously these things, the rising of stock market, falling of stock market, these were not very much discussed in media also. Now today we have
Exactly.
smartphones and all
Media
these
response.
informations are coming every time. And previously, if you also see the cable connections, so cable connections were also very limited. But nowadays, without cable connection, it will not be possible. So we have a lot of business channels, a lot of private channels who are constantly talking about and celebrating 60,000, wearing T-shirts, right here written over 50,000 Sensex and all these things. So automatically people get interested. So earlier we did not used to have this kind of information. But now when these news channels are celebrating excessively, we are also thinking that why this celebration is going on, and then we further look into the matters, and then we get encouraged. So that may also be because of information, availability of more information.
Sir, I would definitely buy your point, whatever is stated. Media response is one of our biggest fundamental factor which act as a behavioral factor impacting the rash decision making as far as investment channels are concerned. And that has been seen as a change. A media response in terms of a positive effect or a negative effect, it has created a level of changes as far as the investment channels are concerned. Absolutely. And people awareness to all the sources has been also a reason for subject to all form of the biases. Thank you, sir, for your expression of the reasons, and that is what exactly the market is also being affected with. So as far as this set of corporate finance, because we all understand the working of corporate finance, I'm not going to state anything new which all of you also don't know, but what I am trying to bring a different flavor to the level of thinking which can further widen the level of our research is that the constant sense of friction between the rational managers and the irrational investors. Or how do, the thing is that I'm not favoring that all this irrationality or all this biases should be there, but the realization of this biases, maybe 4-5 years back when I was pretty much looking into the sense of a finance, and absolutely I had no idea about the influence of these biases. But suddenly when I start realizing and I start knowing that, okay, these are the biases which has been affected, then that has actually helped me to dig deeper into the arena of research and to understanding that, yes, certainly when I started interacting, and right now I'm also guiding one of my scholar who is working in this area of finding out that how do institutional investors, they respond to all this, do they respond to all this behavioral biases or not? Surprisingly, I am finding many more occurrence of these biases, which is affecting them. So the managers need to balance the very pertinent three objectives of maximizing the fundamental value, catering, and the market timing, where we are aware of our fundamental value, that is, we are financing the investment project, we understand the PV value, we understand the IPV in the net present valuation as well as IR while we are taking up the project. But despite of that, we are trying to adjust the level of risk in terms of having a realization of all those biases. We are catering into the investment channels in advanced technology, changing the name of the companies, managing earnings, initiating dividends, issuing bonus, thereby also catering for the needs of mergers and acquisitions. We cannot negate that market timing is not important. The selling overpriced securities and repurchasing underpriced securities, that are also being a factor endowment to the endowment bias of the market timings. So taking further the evidence based upon the behavior of the smart and talented professionals, which implies that the successful excess of that, how do these biases affect and what do the realization of these biases have an impact upon them, one can very well move ahead in terms of a researcher's implications and come up with a sampling in order to test the understanding of how do they work. So here I have come into that three perspective which I visualize as far as the role of this irrationality in the corporate finance world. So one, here you can see that there are certain involvement of the firm, the investors, and the third parties, which are there existing in the world of the corporate finance. In this figure, what I've tried to illustrate is the type of interactions which were analyzed in traditional corporate finance, but a firm seeks financing from outsider investors. Why is that? Corporate finance people, they go for a third party investors in terms of looking into their decision making. Or why a third party is involved as far as the incentives of making any kind of financing. Is it not that only internally the firm and they can look into this matter? Is there any essential conditions that the alignment has to be there between the manager, investors, and the third parties? Yes, no? I would stop and would like to take your opinion based on this. Any point would you like to refer over this? For example, if I looked at a manager, if it wished to expand the firm, right, due to the private benefit. So even when such expansion is not profitable summertime, but this incentive would affect the firm's ability to obtain financing when the investors cannot observe and control the manager's behavior. So what it can lead to, it can create an adverse or impact. So that is why adverse selection, it concerns a different type of asymmetric information, which we call it as the investors cannot distinguish promising and less promising investment opportunities. So as a result, what would happen? A firm can fail to obtain financing from an investment project, and even when it would be profitable to the investor. So for that matter, the firm may resort to signaling through the dividend payment or through a pecking order of financial choices in order to overcome these frictions. And that is what in the figure I had clearly made a kind of association between how do the interaction of the managers and the investors with the third party. So who are this third party? I'm going to take it up in a while, but who are the players? Can we identify who are the players at the firm level, who are the players at the investors level, and who are those who are in the interacting at the third party level? So this identification of these three players has to be very well knitted so that one can come up with a flow of the linkages amongst these three for taking the decision. So at the firm level, whom do we see? Who are the front lines at the firm level? Whom we talk about the corporate governance managed by? Hello, am I audible?
Yes, ma'am, you are audible.
Yeah, madam, you are clearly audible.
So at firm level, we are basically looking into the CEOs, the board of directors, and the employees, isn't it? This is what is the integration at the firm level. At the investors level, we have the shareholders, there are the banks, the commercial banks. There are certain also outside investors who are the target shareholders, as well as certain potential shareholders who are into the selection mode. And likely the third parties who are also belonging a primary part of this level of interaction into the world of behavioral finance. So this is what I was trying to plot it in, that you can see that in this figure, I have clubbed all these three and the interaction amongst this, which includes the analyst who forecast the firm's future earnings, investment bank who offer the assistance with the equity issues, rating agencies who rate the firm's debts, the regulator who acquired the firm to reveal the financial information, and the central banker who are also changing the rates. For example, right now, you might be aware that RBI has come up in the last 1.5 years, it has advocated for a rate cut policy. The CRR was for the 1.5 years, which was earlier 4%, the CRR had come down to 3%. The repos were indicated at 4.75. It had come down below 4. So this kind of change by the RBI, as far as the repos and other quantitative indicators were concerned, was basically to create a fundamental push into the markets so as to increase the investment channels. So all these three factors whom we are noticing in this flow diagram, the firm with the levels of the CEO, the board of members, as well as the employees, monitoring into the impact in assimilation with the shareholders, the banks, as well as those outside investors who are out of this firm, and integrating that with the third parties, which are the analysts, the investment bank, the rating agencies, the regulators, and the central bank. Constantly, they do have an impact upon creating a change as far as the decision is concerned. So any kind of new element or new addition into this framework can bring about addition to the work, thereby calling for a new arena into the perspective of this research. So one of this perspective is the biased investors. How does the interaction work between these investors, those who are with the rational manager, and how do we explain the inclusion of all this into this? The second perspective which I would like to address is the biased manager, who consider that managers are the side of bias, and the question is here whether the non-standard managerial behavior, they are responsive to this, or how far they are able to work onto those challenges, reverse to the first perspective. And third one is the biased third parties, where they tend to make a dichotomy as far as the managers and the investors, and they act as a course of incomplete representation of the corporate finance model. So moreover, what I'm trying to present here is that throughout, we cannot go out of this indexing that either the biases in terms of the valuation heuristics, or it is in terms of the heuristics which occurs in terms of the PE ratio, that have an implication where we see that the biases have been to some extent impacting the corporates through its various existing model, and with the incorporation of these biases, one can very well justify the inclusion of this. To end up, I want to take up with few of these research areas where can pursue for the work. So this network effects has been also a very, very pertinent area of work, where we consider that do network effects affect corporate outcomes? That means, is it that the increase in the number of networking with the corporate world, has it created a positive impact or created a negative impact as far as the corporate performances are concerned? This can be a very, very interesting area of research as far as the corporate financing is concerned. Or one can very well make a study on the investor sentiment and the stock returns, or the volatility of the stock returns. One can also look into the manager sentiments. How do their sentiments and emotions, which I was talking about, the animal spirits impacting the stock return, or specifically the CEO and the CFO characteristics, how do their attributes impact the company's performance, or they do not? Or what is the characteristics of a manager and the investment cash flow sensitivity? Also, research issues can be based on the manager attributes with their financial decision making and the study of various exogenous and behavioral factors which are impacting the decision making as far as various portfolios are concerned. So after all, we are trying to say that we are all human beings, and we cannot negate the fact that either you go for a top-down approach or you go for a bottom-up approach or a composite measure. We cannot negate the values, the sentiment analysis as far as the studies, or to broaden the study of various indexes which without our realization impact the behavioral finance. Okay, so integrating the manager's sentiments, investor sentiments, the top level management, that can be a very, very interesting and a new area of research, thereby mitigating the gaps and coming up with a very area or niche area of work. So thank you so much. I hope I could make some kind of justice and can bring thought to leverage of how to go about a work, because yes, this will require a certain amount of understanding. Yesterday I've shared few articles, few cases with you. If you can go through that, also it will be really, really helpful in further digging deeper into this research.
Yeah, they have been forwarded to the participants.
Thank you, sir. Thank you so much.
Yes, I have done that. So participants, we have a couple of minutes time. Ma'am has completed just on time. So if you have any query, if you have any opinion, feel free to share it with us. A few words from you is definitely charges us up for our next preparation and everything. So those of you who have presented at webinars are well aware of that.
I am also welcoming all of you to our institution. To be a part in any of the ways, you can be associated with us. I am belonging to the area of finance and economics, but apart from that, I am also handling the healthcare management. And we are having an international conference on the area of chaos conflict, which is going on in the recent times. And this conference has been aligned to the Scopus Index papers and few of our in-house journals. So I will be sharing the link with Abhik sir, and you can also follow the website of KIKSOM. So in order to go to the link,
yeah, you share it with me, I will forward it to them.
Absolutely, sir. So you can also contribute your paper for this conference, and I'm sure you will get a lot in terms of the discussion and the deliberations and the outreach through this platform. We are having it in the month of February 26th and 27th, and I am convening the conference. So it will be a very good chance to.
Thank you, Dr. Singh, for your wonderful deliberation.
Thank you so much.
Yeah. So with this, basically, we have come to the end of the technical sessions. So all the 14 technical sessions are now over. And as you know, so we are left with the examination, online examination, which is scheduled at 2 p.m. today, 2 to 3 p.m. We will send you all the links sharp at 2 p.m. Through WhatsApp, through the WhatsApp group. The link will be open till 3 p.m. So please respond. It won't take much time because these are MCQ questions, and now our fingers really move fast on the screens. So it won't take. It will take just as much time as your cognitive senses allow you to take. So complete it. We will have the valedictory, a feedback session from 3 to 3:30, and from 3:30 onwards we will have a short valedictory, and that will be the end of the 5-day long FDP. So I will forward you the materials. I have forwarded the materials which Dr. Singh has sent me yesterday. So you have her email ID. So if you feel to get in touch with Shikta ma'am, you can definitely mail her, and I'm sure, as ma'am said, on the KIT website, her details are available. So nowadays we all are available. It's not that's not an excuse that email IDs or phone numbers are not available. So if there is a will, there will always be a way to reach us. So thank you, ma'am.
Thank you so much, sir.
Yeah.
It was really, and thank you, your university, again for coming up with such a wonderful FDP for this 5 days. And thank you for inviting me. Thank you so much.
Exactly. We will remain connected.
Thank you so much, all the professors over there. Take care. Bye. Thank you.
Okay, thank you. So dear participants, we close this link now. Today we have half an hour less time for lunch because in order to complete the program by 4 p.m. we had to plan it accordingly. So the link, you will be receiving the, we won't open the link at 2 p.m. The link will be opened, the meeting link I mean, will be opened at 2:55 or at 3, because the time is till 3 p.m. At 3 p.m. it will be opened. Okay, so at 2 p.m. sharp, the link, the Google Forms link for the online examination will be sent over the WhatsApp group. Thank you. If you have any query with regard to the exam, you can just ask us.
Thank you, sir.
Okay. Thank you, Dr. Prasad. I hope I have communicated it clearly to all.
Yes, sir. Yes, sir. It is clear, sir.
Okay.